Good morning, everyone, and welcome to our first results broadcast. I'm really pleased you've taken the time to join us this morning. So let me introduce myself. First of all, I'm Tommy Cook. I'm the CEO and founder of Calnex. I founded Calnex back in 2006 after spending 23 years in the test and measurement business, and at that time recognised an opportunity to start a new company, and that was the start of the road of Calnex. I'm pleased to be joined this morning by Ashleigh, our CFO. Ashleigh, do you want to say a few words to introduce yourself?
Hi, my name is Ashleigh Greenan. I'm Big Four trained CA, having qualified with Deloitte, then followed by 5 years at KPMG in their transaction services teams in the UK and Australia. And then since then, I've worked in various group finance roles across a number of industries, including the testing and engineering sectors in both private equity owned and PLC businesses. And before coming to Calnex, I was CFO of Parsons Peebles, a private equity owned multi-site engineering business headquartered here in Scotland.
Thanks, Ashleigh. And Ashleigh and I are fortunate because we're supported by a really strong board in George, Anne and Graham in this new world of PLC. And all three of them have held jobs in executive and non-executive roles, so we're really fortunate to have them guiding us through. So before I talk about the results, I just wanted to perhaps take a few minutes to introduce you to Calnex and what we do. So Calnex is a globally established provider of test solutions for the telecommunications industry. We develop test instrumentation. We build our own physical hardware platforms and load different software personalities on top of them, depending on what critical telecoms infrastructure you're trying to test. We're based just outside Edinburgh in a town called Linlithgow, and where most of our team are, but we also have a design team over in Belfast as well, and we actually manufacture locally in Scotland as well. Since we started and shipped our first product to customer in 2008, we've shipped product to over 600 customer sites in 68 countries around the world. And we've been successful at really selling into all the major subsectors within the telecom sector. That's into the network operators, your BT, your China Mobiles of the world, to the equipment vendors, the Ericssons, the Nokias, and also the component vendors out there as well, like the Intels, Qualcomms. And also increasingly, as we'll show later on, into the new entries, the kind of hyperscale companies, your Googles, your Facebooks, that are actually starting to build their own networks, storage farms, and becoming involved in the whole distribution of telecoms around the world. Now, very much it's a fast-moving industry. There's always new technology coming along. So being able to be established and be connected to the industry is a key part of our business model. And we've formed strong relationships with the key thought leaders and the key customers across the sector. And we also get involved with the standards bodies that set the regulatory requirements for all equipment that's deployed in the networks around the world. That allows us to both see what's coming down the pipe, see what technologies are coming along, where the opportunities are for us in the future, but also to form these relationships with key customers that we hope to build relationships with and to sell through moving forward. We've had a strong financial track record since FY15. We've had a CAGR of around 16%. And we come into this year in a strong position as well, with a strong backlog, and we'll talk about what's happened so far in a few minutes. And we see significant repeat business where, again, Ashleigh, I'll introduce that to you later on, that actually some of our key customers, we've been selling product to them for year in, year out, for 9, 10 years. And that's a key part to our business, is to continue to resell more product, more enhancements to our customers moving forward. But what drives the telecoms industry, or the test industry, I should say, in telecoms, is change. It's new things, new standards, new networks, new equipment that needs to be tested, evaluated moving forward. And there's an unprecedented level of change happening at the moment, both from the emergence of the mobile network, going from 3G to 4G to 5G to 6G to how many ever Gs they get to, the IoT world appearing, the use of cloud services. These are causing huge changes in the infrastructure that's being deployed and built, and that's what's creating the opportunity for us. And it was part of the reason that we decided to move forward, and we were successful at listing the company at the beginning of October to increase the strength of our financial platform to allow us, when we see new opportunity in the future, to be in a stronger position to go after that. So where does test and measurement fit into the telecoms world? Well, it kind of fits in just about everywhere. It doesn't really matter whether you're developing new pieces of equipment and testing these, whether you're manufacturing equipment, whether you're building networks, whether you're maintaining networks. There's always test equipment involved in that. We primarily focus on the design phases, what we call design validation and conformance tests. This is new equipment coming through that people are building, and they have to check out whether it does exactly what they expected it to do and whether it's going to conform to the standards. Now, when you look at the chart in the bottom right, although this is for test equipment, the percentage spend of test equipment, for 5G, it actually is very typical of what you'd see in any spend cycle. And you'll see at the very beginning of new technology coming along, represented by the silver bar, most of the investment in test equipment is into R&D. Obviously, that's where they need it. But even once it gets into the manufacturing and into the deployment phase, it's still into R&D that they spend the most money. And the reason is that we are an enabler to our customers. If we allow them to test their equipment or prove their designs effectively, prove that they conform to the standards, then they can get their equipment to market quicker and obviously generate new revenue streams. So that enablement allows us to provide, if you've got the right product at the right time, you can command a high price and generate good margin for yourself. The other place that we focus on is the maintenance test. A lot of installation these days and first level maintenance in networks is very much has been, if I must say, de-skilled. People just plug things in, check it works. If it doesn't seem to work, they just swap boards. If that works, it's done. But when things start to go, you've done the kind of first level maintenance and it still doesn't work, then that's when you have to bring along the tools that really give you deep insight to what's happening in the network at this point, that this piece of equipment won't work, whereas it's working in other places. And that's where we provide tools, because that kind of ethos of deep insight, high capability, that really fits into what we do back in the R&D phases. So that's kind of what we do. We basically provide test solutions that allow our customers to get their equipment to market quickly. And it's not just quickly, it's robustly, and that they get good design margins, that once it goes into manufacturing test, they don't have yield problems. Once it's deployed in all the various topologies around the world, they don't get problems in the network, which means they have to fix post-deployment and potentially have, which costs them money or actually costs them reputational damage. So what's been happening over the last period for us in the last 6 months? Well, actually, we've had a great period. In FY20, we've seen really strong growth from H1 to H2. And coming into this H1, basically, we've sustained that level of business that we had in H2 last year. So when you compare the two H1s from this year to last year, you can see we've had a really strong result, 37% growth in revenue, underlying EBITDA up nearly 70%, and a very positive cash flow. So really our industry is continuing. We are actually seeing from a repeat customer basis, as Ashleigh will show you later on, we have a very high level of customers that buy from us that have actually bought in the past. That's very much continued this year in the same trend as we've seen from previous year. No real change there, the same positive thing. The new products we're coming out with that we came out with last year, the new things we're coming with this year have resonated with customers and encouraged them to buy again. And the market conditions are still very favourable for us. And we'll talk a little more about COVID in a minute, but underlying the need for telecoms, if anything, it's been reinforced. There may be ripples in the pond over the next period, nobody can tell, but I think you can say underlying the need for telecoms has been strengthened, if anything, and the need for effective broadband, effective mobile has been stronger. So we've continued to expand our team through this period, and we plan to do so going forward to really maximise this potential that seems to be still with us moving forward. As I mentioned, we've managed to get the company across the line on the 5th of October, and we were successfully IPO'd the company, raising 6 million for the company out of a total 22 million that was, from an offering that was oversubscribed. So if I look more closely at what's been happening in the last 6 months, unfortunately, you have to start by talking about COVID. Let's talk about the negative and then go into the positive. I guess it was a surprise for most people. We had to suddenly move into working remote from home, and we've done that. Virtually all our guys are working from home except a small manufacturing team. They've continued to go in, obviously following all the government guidelines. But it's actually worked very well. And in fact, we've moved on from talking about is there are problems to actually, we've seen a lot of real benefits from working remotely. Work-life balance has been better for a lot of people. We've got people working, we've got a design team in Belfast and here, and that actually it's improved their working relationship. So we've very much focused on to, when we move back in next year, is how do we actually keep the good things that you get from remote working and build that into the office environment so we get the best of both worlds. We always like the best of everything. So really it's worked well for us. We haven't had to make anybody redundant, put anybody in furlough. Everybody's continued to work normally and as effectively as they were. Our HR team are really focused on doing that, what you miss in the office, that kind of casual conversation, relationship building, but also the things that triggers ideas in people's heads. And we have kind of virtual coffee breaks, Thirsty Thursday, Treat Tuesday, where we kind of encourage people to just come and speak to one another, even if it's not directly about work, because we want to keep that kind of engagement and that strength of the team reaction. So within the company, it's gone well. But also equally importantly, in our customer base, they also seem to have transitioned into working from home very effectively. So they are continuing to work, and that's obviously key, because if they can't keep their projects going, then they're not going to need test equipment, and they've basically managed to do that. So everything seems to, in our customer base, has transitioned into working from home successfully. So the bottom line is we really haven't, and I feel very fortunate when I can see a lot of businesses struggle. We really haven't seen any negative impact of this. It's been business as usual for us. Things have continued. Some of the spending patterns in our big customers has altered slightly. It's a bit like personality-wise. These companies have personalities. What do you do if you think there's trouble over the horizon? Some companies actually spend quicker because they're worried their capital budgets are going to get cut and they won't be able to spend, and other people slow down, and we've seen a little of that. So there has been slight unusual spend patterns in this first half that we expect to kind of continue. But if you balance them out over the whole portfolio, it's pretty much business as usual. We actually have seen a benefit that we've stopped traveling. We travel a lot because it's an expensive sale, our products. Each product sells anything from £50,000 up to £150,000. That's expensive equipment. So we engage with the customers a lot. And we've obviously had to do that remotely. And so we've actually seen the benefit through the period of the 6 months. We probably saved £300,000 that we'd expected to spend on travel that we didn't spend. But that's a short-term benefit. And once we go back and come out the back end of this, we would expect to go back to travelling again to continue to build these relationships. We haven't taken any of the government assistance, things like the deferred VAT. We haven't had to do that. And our supply chain has continued pretty much unaffected. Our contract manufacturer very quickly moved into taking government guidelines put in to protect the workforce, and they've continued throughout this period to deliver product aligned to our forecast. And they haven't seen too many supply chain issues. We don't really work in because it's low volume and high complexity, our products, it's not a kind of just-in-time model, so they tend to buy, and our contract manufacturer has increased the purchasing of equipment to make sure that if there is any kind of short-term issue with getting some components, they don't have any problem in the ability to deliver. And so far, it's been fine. Things are going well. So looking forward, we feel that we're quite resilient. Yeah, there's going to be ripples in the pond. I think it would be folly for anybody to assume it's all over the impact of this, but we don't feel as if we'll see too much. Our business is spread across the world. We kind of see it in kind of 3 equal parts: North America, Asia, which is really China, Japan, Korea, and then the rest of the world. And business has gone well in regions. We also have seen through in the past, because we're so spread, when there's issues in one place, then we're protected, we are resilient because our customer base is across the world. And in fact, China is almost back to normal. Our guys are reporting, everybody's back in and working as normal there, whereas obviously in Western Europe and North America, that we still got a bit to go to get back to that point. We're continuing to innovate because our products are still going forward. Our development teams are continued just as efficiently, if not slightly more efficiently, dare I say, working from home. So things are going well. So really, when we look forward into this next half, although we can kind of see some ripples, we very much expect to see the second half to be broadly in line to what happened in the first half. And underlying, as I mentioned before, I think this is strengthened even today. In the past, I'd have been down in London standing in front of you. We're all using broadband. If there's not that infrastructure there, then this is difficult to do, and it's reinforced the need for countries to invest more in creating that resilience. So underlying, we believe that this has strengthened our position moving in the kind of medium long term, and we think in the short term it's proven over the recent period that we are resilient to what's happening, and we can come out through quite strongly. So at this point, I'm going to pass to Ashleigh. She's going to talk a bit more about our business model and give you some numbers.
Thanks, Tommy. Just as a high-level introduction before I go on to the next slide, Calnex has experienced strong revenue, gross profit and EBITDA and cash performance over the last 3.5 years, with a good spread of trading across geographies, including high levels of repeat demand, as Tommy was just saying, from our top-tier customers and our overall customer base, while our overall customer base has also continued to grow. So to explain that in more detail, I'd like to take you through how we generate and recognise revenue first, and where that revenue's come from, just to give you a bit of a background. to our revenue model before going on to show you the results from this half year. So, as you can see from the graph in the top left of the slide here, the company's experienced healthy growth in revenues over the last 3 full financial years. FY19 saw growth of 25%, and then growth in FY20 was higher still at 31%, as you can see from the graph. Calnex generates revenues through the sale of bundled hardware and software, which is usually around 90% of our business. This revenue is recognised either on dispatch of the hardware or delivery of the software license key to the customer, as well as software support and extended warranty programmes. And that part of our revenue is recognised over the life of the product and takes up about 10% of our revenues. So bundled hardware and software sales pricing can differ depending on the product and the numerous software option choices that each product can offer, which are then configured based on the individual needs of each customer. And we also sell standalone software upgrades as well. Once a customer has purchased a product with software options, they can come back for upgrades that are added to the existing hardware through the provision of a license key. And this means that the average price per product can vary from PO to PO and transaction to transaction due to the variability and the flexibility of the product options that are available to our customers. And as a result of our global customer base and our distributor network, we've an almost even split of revenues and orders, as Tommy was saying, across our 3 geographical divisions, America, North Asia, and the rest of the world, which you can see from the pie chart at the bottom of the slide. And that just allows us to build our resilience and spread our risk across our global network. And just moving over to the right-hand side of this slide, although a lot of our customers are telecoms customers, a growing proportion of our customer base are from non-telecom sectors, which include the hyperscale enterprise customers. And in FY20, 22% of our orders came from these non-telecoms customers, and that's grown from 14% in FY18. And you can see that effect on the following slide, as non-telecoms customers are now included in our top 10 customer list over the last 3 full financial years. In FY20, just to give you a flavour, 14% of our top 10 customer revenues came from non-telecoms customers. Our top 10 customers are all top tier and have overall contributed to 52% of total revenues in FY20, and on average across the last 3 years, 48%. In addition, the average length of relationship that we have with our top 10 customers is 9 years, which demonstrates our high level of repeat demand from these customers. And it's not only our top 10 customers, we also have a high degree of repeat revenue demand across our whole customer base, which you can see from the pie charts on the top right-hand side here. Over the last 3 years, repeat revenues generated were on average 83% of total revenues, whilst the total customer base continued to grow from 139 in FY18 to 177 in FY20. And this repeat demand can be demonstrated by the graph in the bottom right of this slide. This shows the revenue trend for our 3rd largest customer in FY20, just picked as an example, because it's quite representative of the sales profile of a large majority of our customers. And as you can see, the revenue growth, which is the red area chart in the back of this graph, it's not only driven by the sale of the original product, the hardware, which is the grey bars, which would have had software attached to it at the time, but a significant proportion of this growth can be attributed to the sale of the software upgrades as they come through, and a combination of them both. So this graph not only demonstrates that repeat demand, but also shows you that bundled hardware and software concept as well. So I'll take you through, firstly, the income statement, so you can see this revenue model in context. So revenues generated in the first half of this year were 7.7 million, compared to 5.7 million in H1 last year. We saw order intake and revenue performance increase across all 3 product lines in the first half of this year compared to H1 last year, trends which were on the same run rates from H2 last year. Gross margin in the period, which is net of any discounts we give to our channel partners, was 78%, which is in line with our FY20 average gross margin for the continuing business. Gross margins can fluctuate through the year depending on the mix of the products and the mix of the bundles of hardware and software. And this mixed variability is just the reason between the slightly lower margin in the this half year compared to last half year, but usually just levels out for the full year. Admin costs which excluding depreciation and amortization, were 2.7 million in the period versus 2.3 in H1 last year. But if you adjust that for exceptional costs, which are the IPO costs that we incurred up to the 30th of September, share-based payments and discontinued operations in the previous year, results in the admin costs were 2.3 million, the ongoing costs in H1 FY21 compared to 2.2 in the previous period. And as Tommy mentioned earlier, we've experienced savings in travel and events costs as a result of COVID-19. And this has been offset by increases in the sales team commissions as we hit and exceeded our internal targets, and as a result of the revenue performance. The share-based payments of 0.2 million here, they relate to the share options in issue at 30th of September 2020. The vesting on those options was all conditional on a change of control. So when we IPO'd on the 5th of October, all those options vested. And as those costs relate to the IPO event in isolation, they're classed as one-off in nature. Also, of the IPO fees pre-IPO were 0.2 million. They're treated as exceptionals here as well. And the full IPO costs for the period will total just under 1 million. Underlying EBITDA is one of our key KPIs that we use to manage the performance of the business. And this EBITDA metric treats R&D amortization as if it's a normal overhead of the business. So it basically just includes that amortization, but excludes any other normal depreciation and amortization on any of the other assets. It's also adjusted to exclude exceptional costs as well. Underlying EBITDA grew 69% in the period to 2.6 million as a result of the strong trading performance, but also as a result of the savings that we've benefited from as a result of the COVID-19 travel and events not happening. Underlying EBITDA margin is 34%, which is up 4 percentage points on the average for FY20. But if you strip out the cost savings, or you add the cost savings back from the no travel and events, which was about 0.3 million in the half year, it'd be closer to 30%, which is in line with FY20 averages. Amortization of R&D costs itself increased by 0.3 million in the half year compared to the previous half year, and that's as a result of our continued R&D investment over the period. And all of this resulted in an adjusted profit before tax, which excludes the exceptional costs, of 2.3 million in the period compared to 1.2 million in the half year last year. Adjusted basic earnings per share was 3.02 pence in the period, and that's compared to 1.58 in the previous period. Adjusted EPS excludes the IPO costs and the share-based payments in this year and the discontinued operations in the previous year, just to show like for like. Then on to the next slide, just to show you the cash flow. As you can see, the group generated 900,000 of cash in the half year compared to a net decrease of 0.3 million in the previous half. And this is driven by the trading of the business, of strong trading. Net cash generated from operations was 2.7 million in the period compared to 1.4 last period. Working capital movements represent a cash outflow of 0.6 million. That's all timing related, driven by stock balances being higher as a result of the timing of the shipping of the product out to our customers as our performance grew and the shipping increased. And the effect of our FY20 year-end bonuses. We exceeded our budget targets in FY20, paid out our bonus in April, so the accrual for this year hasn't had time to catch up with the cash outflow for that. So we should see that working capital level out for the full year. Cash used in investing activities is predominantly cash spent on R&D, which is capitalised and amortised over 5 years. Cash spend on R&D in the period was 1.5 million, in line with the previous half year, and we anticipate this to increase over H2 as we start to invest further in our R&D teams. Cash spend on financing activities in the period was 0.4 compared to 0.3 last half year, and that's driven largely by the monthly capital repayments on our Syncats loan, which is offset partially by cash received in from government grants. The outstanding balance on the Syncats loan was 1.9 million at the end of the period, and on the 6th of October we actually repaid that loan in full. So we are now term debt free. We replaced that with a £3 million revolving credit facility provided by Barclays. That was put in place post IPO, is currently undrawn. The interest rate on the Barclays RCF is 2.25% over base rate for any drawn funds and 0.075% for a non-utilisation fee, which is compared to the 11% fee we were being charged for the ThinCat loan. So you should see the finance costs in the P&L and the finance cash outflows reduce in cash going forward. Now I'll pass you back to Tommy to take you through the rest of the slides.
Okay, thank you, Ashleigh. So just to kind of have a quick chat about strategy going forward, really there are big trends happening within the industry. 5G is presented to the consumer world like it's a spot technology, it's some new widget that here you go. But to me, it's not. It's a vision for how they're taking the mobile network forward. It's the same when they went from 4G to 5G inside the industry. We talked about 4.5G, 4.9G, 5G, because there's a continuous change happening. It's not just one. And that's really what's happening with the 5G. It's about supporting the smart cities of the world. It's revolutionising the network to be able to support the users that want to use it in the smart cities. So it's going to be a continuous growth. And you can see from this report from Frost and Sullivan that the spend on test equipment associated with the 5G technologies is growing healthily. It's already a 1.5 billion market, growing to over 2 billion by 2024. And in fact, if I showed you a picture to do with cloud computing, and the movement of the creation of these storage farms, the movement of people using services into these, there's pretty much a similar trend where the market for that, for test equipment, is already over 1 billion, growing roughly the same sort of rate and heading towards that 1.5, 2 billion in the second half of the decade. So very much there's a huge opportunity for us here. It's a continuous evolution path. There's a lot of new technology coming along, and for us, each of these bars represents lots of niche markets in there, and each niche market is associated with a new type of technology, a new interface, a new standard, and needing to test to that. And obviously that's what we need to do, is identify these and then provide the right solution to the customers moving forward. So on the next slide, you can see that really we have a three-pronged approach to our strategy. First of all, is to continue. We're already well established in the 5G technologies around the world, or the mobile technologies to be more rightly. And we're going to continue to follow that, continue to enhance our products as we see new standards, new technologies come along to enhance our position, to move into adjacent markets. And the same with the cloud computing. We have our product lines that address what's happening in the cloud computing, the movement of services into there, the building of these huge storage farms and the management of these huge storage farms. And that's where we continue to look for opportunities. And we'll do it both organically, as we've done many times up until now, identify opportunities ourselves, innovate a product that's required, design it, build it, deliver it. We'll keep doing that. But we also plan to do M&A. Up until now, we've done 3 acquisitions, and that's really been successful to us. It's got us new product lines. It's been, we've learned a lot over the 3 that we've done. And it was part of the reason that we decided to actually float the company, was to give us a stronger financial base, that when we see companies that we feel that can actually complement what we're doing, enhance our portfolio into customers, or take us into new areas adjacent to where we are, then basically being a listed company, it gives us a stronger position to go out there and aggressively acquire companies and bring them in and strengthen what we're doing going forward. So very much, in the near term, it's business as usual. The development teams are continuing to work. They're all settled in. We're starting to look at post-COVID, how do we actually keep all the great things, actually the improvements in working practices that we find, how do we build these into the post-COVID world and make sure we benefit from that and enhance our working practices, effectiveness, enhance our work-life balance for our people, which in effect will enhance our effectiveness. We've got an exciting product roadmap coming along with some enhancements coming out in this next period that we believe will continue to grow the market for us. And again, of course, nobody can take their eye off the COVID ball at the moment. We're definitely not out of the woods of this thing, and we need to be aware, and we're continuing to look at customers, how our customers are operating. Are they continuing to work? Because that's the indication for us that things are a problem. If our customers are finding it hard to keep their projects going, then we know that might lead through to us. But so far, everything's looked fine, and we're continuing to keep a close watch on that. Just kind of summarise and close off. We are a globally established provider of test solutions around the world, and that global position is strengthened and has always been beneficial as we see each region wax and wane, that we are strong across the world and we can keep going forward. And in situations like this, when different phases of the world are going to come out of COVID at different times, hopefully that helps us to have a robust situation. We've got winning products, we've got ideas to bring new things forward, and we keep working with our customers. We've managed to keep those customer engagement through this period, and we need to keep doing that and know what our customers need going forward to make sure we keep delivering what they need. And that will allow us to continue a strong financial track record. And I guess we're growing our customer base. We have a lot of repeat business, as Ashleigh showed, but we're always looking for new customers, and especially into that hyperscale place. We see that's a growth opportunity for us. And the structural things that are happening in the world, we believe in the medium to long term are actually strengthening our position, they're not weakening our position. So for this the near term, we very much anticipate that our revenue and adjusted PBT in the second half will be broadly in line with the first half. And obviously now that we're through the IPO, we're a listed company, then we're now starting to execute that springboard of creating a platform that hopefully will create more growth moving forward. So at that point, I'm going to stop and take any questions anybody has.
Kevin Ashton at N+1 Singer. Go ahead and ask your question, Kevin.
Good morning. Just maybe a couple of questions. Obviously you've talked about your position in, your position overall, but you've talked about the potential of 5G. Can you give us some kind of idea how much of the revenues at the moment, even vaguely, are actually 5G? Because I imagine you've still got an awful lot of 4G business as well. Is it just a sense of where you are in that area at the moment?
Yeah, you're right. In terms of splitting between 4G and 5G, it's always hard for us to do that, and it's not because I'm being evasive, but our products are platform products, and when new technology comes along, when our customers like an Ericsson or Nokia start developing a new piece of equipment that need to comply with 5G, they also still need to, because nobody rips things out of equipment. They need to still test the 4G, the 3G, all the other equipment. So I think it's very much, especially in a new in a lab sync product, a new platforms very much selling the headline is that it's ready for 5G. So even if you don't need the high accuracy today, if you buy that platform, you're in a good position to get a software or a hardware upgrade in the future to it that'll allow you to then test it as soon as you need to test it. So a lot of that business is starting to move across to that. And if it's not being used initially to test 5G, they've kind of purchased the product that can be upgraded, because everybody knows if they're not testing 5G today, they will be quite soon. So if you are buying new test equipment, you're looking for that, being able to sweat that asset moving forward as you move forward, which is really part of the model that we have to meet, selling into that R&D space, that our customers know what they need today, and they know they're going to need something different in 9 months or a year, and they have to rely on us that we will actually have that capability available to allow them to enhance their products, enhance the test solutions as they move forward.
Okay, thanks. That's helpful. Maybe just another question or two, if I may. But could you explain a little bit about the relationship with Spirent? Obviously, it sounds like a lot goes through them, but in terms of which areas, I guess, kind of renewals, anything, the kind of colour, I guess,
sure,
that we'd expect would be useful.
So we've always sold indirect. We have a couple of customers we sell direct to, but in general we use either regional channel partners or somebody like Spirent. And over the years we've actually changed it. So in the early days we used regional partners. Then we actually started working back in 2010 for a few years with what was then JDSU, they're now called Viavi. And it was always a sales channel relationship. And then we went back to regional partners, and then Spirent came and asked, they said they wanted to resell our products because it enhances their portfolio. And so it's a pure resale arrangement from the point of view that we control the product roadmap, etc., where the investment is, and they resell it. If you look at our products, you'll see that some of our products, they just resell it in its badge Calnex. Some of them, they rebadge it and call it Spirent products. But you'll notice at the top it may say Spirent, but on the bottom right it always says Calnex, powered by Calnex. And that's been a key thing for us, is that the customer knows where the product comes from. And our products are complex products, so there's always, even if there isn't, in some cases Spirent can drive the pre-sales engagement themselves, but it's quite often we're involved in that as well, helping the customer understand the value of the product and their application. But any post-sales support comes back to us. So it's key to us that if we have to change our channel in the future, because we've changed it a number of times over the years, that the customer knows where the product comes from. And at the times when JDS decided they didn't want to sell our products anymore strategically, they didn't want to work with partners, we just immediately phoned up the customers, the deals are ongoing, saying, hey, you need to buy through this other channel. Now, it's still the same product, it's still the same people you're working with. It's a different sales relationship. So, but in saying that, we've been working with Spirent for now 6 years, I think it is. It's a good, strong relationship. I think we've been, and they freely tell us, we've been the most successful partnership they've ever done with anyone. We work well together with one another, and we wouldn't expect that to change in the near term. But we're always aware that, you know, things can change. We may change our view, they may change their view, and that we could, you know, the relationship may change in the future. But at the moment, it's going well. We obviously benefit from their large sales teams they have, especially in regions like the US and in China, and so we plan to continue to use that for the time being.
Ian McInally from Senkos.
It was really just a question on expansion of R&D. It's something that you've been pointing to, which obviously leads to, you know, broadening capability of existing product lines and obviously adding new ones. Just if you can talk about, you know, the potential for expansion of the R&D team over the next, you know, for the rest of this period and into next year. You seem to be accelerating that faster than had been previously anticipated, which is obviously good news. But and I think also the timing of, you know, once the R&D team is expanded, the length of time it takes for you know, that sort of bed in and for the sort of fruits of that, if you like, to you know, to come to bear on future growth.
Okay, yeah, no problem, Ian. So yeah, really very much as part of the IPO, we said we were going to use some of the proceeds to enhance both our business development and our R&D teams, you know, give some more feet on the street in key regions to actually boost that ability to engage with customers and also bring in more R&D people. So we are looking to hire another 10 R&D people over this period. We actually have been hiring recently, and you know, the first part of the year it was a bit slow, but we're actually finding we're getting people in, both in a team in Linlithgow and in our Belfast team. We'll be looking to hire people into that. And I guess if you know, when we bring people into R&D, it takes a bit of time before that starts to come through to results. As you can imagine, somebody coming in working on a project until they get up to speed, that project gets released. And most of our projects take somewhere between 6 to maybe 14 months, depending on the size and the scope of the project. So obviously, it depends when that project gets released and then ramped up. So we would expect to see a benefit of that starting to go through towards the end of next financial year. The business development guys, they can probably start to deliver in a kind of 6 to 9 month period. But it's about enhancing. You know, we've got more. We always have customers asking us to do more than we can do. So and that's always a healthy place to be. So it's about enhancing. You know, picking the targets, going after, accelerating some of our programs within our current portfolios, where we know there's other opportunities where we can get new capability that will enhance or encourage people to buy additional options, additional units moving forward.
And we have a question from Peter McNally at Panmure Gordon, who asks, who do you see as your competition?
Yeah, it varies by product line. We've got 3 main product lines, and it's really quite different in each one. The lab sync, which is really testing the 5G technologies that we get involved in the R&D phase. At the moment, we are quite dominant since we come out with a new platform there. We are the only people with a very high accuracy. There are solutions from some of the other big players that you would see out there, like Viavi, but really they can't do all the technologies we do. They do some of them. So really for our target customers, we're quite dominant. In China, we've got a competitor there called XG or Shaguan, using their Chinese name. And we've managed to keep them pegged back in China. They did try to come out to China a couple of years back, but they weren't very successful. So they're in China. But again, they don't have the high accuracy. So as long as we keep following the innovation waves and staying at the front, we can keep them at bay. You know, we don't really discount very much in China. We've managed to command a high price. And as you know, there, as soon as you get into a commodity market and there's local competitors, you're going to get hammered. So very much we need to keep that in the lead, and we do that. And they very much look, bizarrely, to the UK as being somewhere that creates innovative solutions and leading edge. So, you know, it very much benefits us from being here. And so we, in that product space, again, we're dominant, but we're always aware that there's people nipping at our heels. If you go to the maintenance market, bizarrely, I would say we get no competition, and all the competition would say there's loads of competition. And the reason is that there's lots of maintenance testers that are more like general purpose toolbox. Think of them that way. You know, they've got a bit of everything, because the guys that do maintenance, the engineers that go out and maintain networks, each day they're maintaining a different type of technology, so they need base capability. But what we do is we focus very strongly on this synchronization technologies. And so we very much say, look, if you've got a major problem, your general purpose toolkit's not going to work. You need a specialist piece of tester. So really the competition, you know, the debate there very much is persuading the customer they need that specialist. And in fact, as they move to 5G, they get moved to higher levels of complexity inherently in the technology that's going to be used, then we believe that argument of you need a specialist tester will strengthen as we go there. And then lastly, in our third set, the ones that we sell more through Spirent, the emulation products, there are other competitors out there, but we have a rich portfolio. We've got a hardware product-based solution that basically allows you to, for the high performance applications, the high accuracy applications, we've got a solution for that. If you're more interested in multi-user, multi-rate, more flexibility in the kind of network scenarios that you're trying to emulate to test your equipment, then we've got a second product for that. And next year we'll have a product that's more in the virtual world. So our strength there is we've got the full portfolio. So it doesn't really matter whether you're a guy that's working at the performance end or the complexity end, or you might be doing a bit of both, then we're the guys that have got a solution for all that capability.
Thank you. And Peter goes on to ask, have you experienced much revenue growth variability between telecom upgrade cycles?
There's always lumps, you know. I think if you remember back to that picture that Ashleigh showed of that, you know, a third customer, you'll see it was a bit bumpy on the top. You know, our products are quite expensive products at the end of the day. So, you know, if customers kind of slow, you know, delay a month or two before spending and placing purchase recs for 100,000, 200,000, or they bring them in slightly earlier, then you create that bump in the road. And again, our spend quite often is related. Again, it depends. Each customer has a different kind of personality. Some of them, it's very much related to the project. We have to wait to their projects for their new products is enabled and gets approved internally. Then their budget to spend on capital equipment gets approved, and that's when we get it. So there is kind of bumps along the road. But again, as we've got bigger, the relative size of these bumps has got smaller. The kind of spread being covered and covering all the customers, because it's rare that all these bumps kind of line up and they kind of smooth things out. So there are always bumps, but hopefully we can kind of manage our way through these, and they will kind of become lesser as we grow in size.
Thank you. And we can now go back to Kevin Ashton at N+1.
I'm just curious on your guidance. I mean, you pointed, Ashleigh, to the very strong growth you've had over the past years, and obviously in this half it's very strong as well. And but you're actually guiding to 7.7 revenues in the second half as well as in the first half. Is there some kind of seasonality of the business that I'm not aware of, or what is your visibility into that number at this stage, if those questions are okay?
You know, I often say in normal years, and then I wonder when we have normal years, because they don't seem to happen very often. But in a kind of normal year, we would kind of expect the second half to be a bit stronger than the first half. There is a slight seasonality in spending, but it doesn't always happen. And again, you kind of have to look at each regions. You know, different regions, as you know, in China, they kind of close down a bit for Chinese New Year, and the different periods, and obviously it kind of varies. So we see these effects. You know, I think in the second half we are guiding to have the same, because we have seen a bit of change in spending patterns this year that I referred to earlier. We have seen some, from an order point of view, some orders we've got a bit earlier than we expected. It wasn't a revenue number. So I think that's why we feel comfortable that the second half's going to be pretty much the same as the first half. We tend to have a reasonable visibility about 3-4 months out. You know, we're feeling okay at the moment about that. Into the end of the half, then obviously, you know, there may still be ripples there. We need to see what happens. But I think this year, we think the way people have been spending it, and that kind of slight change, as I say, I don't worry that underlying the kind of the market's changed, but that kind of near term, there might be some minor changes, and that's why we feel the second half, the kind of prudent, right approach is to assume that the same as the first half.
And that's the end of questions. Tommy, do you have any closing remarks?
Just to say thanks very much for coming along. Hopefully I gave you the right questions. This was a new experience for me, so hopefully I got a mark greater than 5 out of 10 for it. But you know, I think we're feeling good about the business. You know, the guys have settled in well to this world. Hopefully we can come into the new world quite soon. We kind of feel the underlying drivers in the business, if anything, have strengthened. Yeah, there might be ripples in the road. There's always ripples on the road, let's face it. But we're feeling good about where we are at the moment. And obviously, now we're a PLC and got through that, we need to, kind of execute on our strategy of taking forward in this new world. So thanks very much for joining today.